Welcome to Pierpoint Perspectives, the securities finance podcast delivering commentary from the best, brightest and most innovative people in the world of securities lending, repo, collateral management and related areas. Pierpoint Perspectives is brought to you by the consulting team at Pierpoint Financial. So now, over to your hosts.
Hello and welcome to episode 13 of Pierpoint Perspectives. I'm your host, Roy Zimmerhansl, and practice lead at Pierpoint. This episode is focused on exclusives. Now, exclusives are an arrangement whereby an investor's portfolio, or a subset of their portfolio, is earmarked for the sole borrowing use by one or more investment banks. Now, these arrangements are very much specifically tailored for individual transactions and situations, so they're quite customized and unique. Now, there was a time, maybe 15 years ago, where exclusives were a really critical part of the securities lending scene. Then along came the global financial crisis, which kind of followed on by the Lehman Brothers default, and that changed everything forever. First of all, the demand for borrowing securities was cut back dramatically. And then secondly, and more importantly, regulations that changed in the aftermath of Lehman Brothers changed the economics of exclusives, perhaps forever. So today, I'll be asking my guests to share with me their experiences and their thoughts on exclusives, good and bad experiences, and what the future holds. Now, in my own case, I first came across exclusives in the mid-90s when I convinced an insurance company in the UK to give me exclusive access to their Thai portfolio, and it was a great success. Now, both my guests today have had experience directly with exclusives. My first guest, John Arnesen, who's practice lead at Pierpoint, he's experienced exclusives from the perspective of an agent lender at two different banks. Now, sometimes he's had these exclusives thrust upon him, and sometimes he's been the one that's initiated the discussion, so he has a broad range of experience from different angles. We're also joined by Jeroen Bakker, who is our Benelux practice lead. And like myself, Jeroen's experience is with exclusives both as a borrower and as a lender. So that's quite a recipe for lots of experience, lots of thoughts and views. And so let's get to it. John, Jeroen, welcome to the show.
Good morning, Roy.
Good morning.
Right. So today we're going to be talking about exclusives, as I said. So I think the really important thing is we're all talking about the same thing, or if we're talking about different things, we at least understand what those differences are. So maybe, Jeroen, I can ask you to start. What does an exclusive mean to a borrower?
Well, you're quite right to ask that question, Roy, because exclusives mean different things to different people. But for a borrower, you can say an exclusive mean the right to have exclusive inventory from a beneficial owner. So the beneficial owner will circumvent, would hold separately a set of this inventory, but only for that particular borrower, which means that the borrower will then be able to use that inventory as his own wish, whether he can draw it down or not, but it's there for him, and in return, he is willing to pay a fee for that.
And is that just one thing, or are they different? Are there nuances and differences in terms of what a borrower might need?
There are definitely nuances, and different borrowers want different things, but it's predominantly driven by their demand from their external hedge funds or their internal trading desk. So if they have an internal trading desk that is very active in one particular market where they're market making, the borrower wants to make sure that he has sufficient supply in that particular market and will go out to a beneficial owner and try to capture that. And that could be equities, that could be bonds, that could be different kind of asset classes and in different markets and different tenures.
But I guess what I'm hearing from you is that it's very specific in terms of the assets they want, and that specificity might vary borrower by borrower.
Indeed.
Okay. So, John, that sounds pretty straightforward to me, very clear. What does an exclusive mean to an agent lender or indeed a beneficial owner? Or maybe there's differences even between those?
I think we can use the term, but I think there is a subtle difference from an agent lender's perspective and maybe from an institutional investor's perspective. In its rawest form, an exclusive arrangement between an investor and, as Jeroen describes, let's say a prime broker, may not be within the framework of an agency lending business. In other words, we may not even know about it, because why would you? It isn't securities lending as we know it. It has different characteristics. So you could argue that a very sophisticated beneficial owner, for what to use our own parlance, could make that arrangement. It could go via a custody instruction route, and that it's sort of outside of the framework of what we would typically know. Now, I think that's unlikely because, as we know, in having to service some of these arrangements, the practicalities of all the movement of collateral, the marking to market, and all of the functions that we would typically have when we have discretionary lending still exist. And therefore, the client needs some type of support in performing this task, and therefore it's typically going to end up either within a carved out unit within a custody framework, or, as is probably the case, a carved out unit within the framework of a securities lending business unit.
So, John, for all intents and purposes, it is a securities lending transaction. Any way you look at it, has all of the characteristics to it. It's really just a question of who has access to it and what are the terms of that access. So is that right?
Well, yes, but I would say from a borrower's perspective, they're all exclusives. I think from an agent lender's perspective, it could be an exclusive that the agent lender has proposed to a beneficial owner. It could be a beneficial owner is suggesting to the agent lender they would like to enter an exclusive, but the agent lender may suggest back to the beneficial owner, that they should run an auction process for them. Now, from Jeroen's perspective, it's all exclusive to him, but I think we need to discuss the subtle differences between an exclusive arrangement and the auction process.
Right. So, Jeroen, that's a good point. So, John's talked about a number of different variables. One where the beneficial owner and the prime broker or the borrower have a direct relationship. One where the agent, defensively, maybe by being asked from the beneficial owner, can you get a better return for this? Maybe they've got that kind of an arrangement. And then there's the proactive situation where the agent lender might suggest that a portfolio should at least be considered for an auction and go down that exclusive route. So as a borrower, do you look at those arrangements differently, or are they all just different routes to get you the same stock?
It doesn't really matter. The borrower just wants to have that supply and wants to make sure that it's his supply and nobody else can touch it. So if that means that the borrower will contact the beneficial owner and get a one-on-one relationship in place and start borrowing securities directly, or if it means the borrower will participate in an auction that's been sent to the market in order to drum up bids and get a price out and get a value, intrinsic value for the portfolio, or if it's a one-on-one relationship between the agent lender and the borrower, whereby certain exclusives are traded, technically it more or less is all the same. From an operational perspective, I would say the borrower would probably prefer to have the agent lender in the middle, because it will streamline the flows, it will streamline the recall process, it will streamline the new transactions, the fees, the billing, all those kinds of things that an agent is good at. Makes it easier for a borrower to transact a exclusive through that route.
So, John, just following on from that, What value do you think an agent lender brings to this exclusive process then, right? Because if the beneficial owner is dealing directly with the borrower to make the terms and arrangements, then I can see how the agent might add some operational support. But what else do they add?
If only they did, because a beneficial owner going directly to a borrower has failed to recognize the sheer amount of work, effort, and risk mitigants that an agent lender brings to the process. When this was first thrust upon me around 2000, 2001, it was literally that an underlying client of ours had made an arrangement with a borrower. I said, I want this to go live, and here's how much I'm going to get paid. I'm going to give you your fee split. Away you go. And of course, the response to that was, well, what are the caveats around it in terms of volume? Do you expect to have every single one of your securities taken down, and therefore your concentration risk of that borrower is acceptable to you? Oh, no, I expect you to fully indemnify me as well, which is the dynamic of the conversation. So I think that the arrangement I'm talking about here isn't really practical from a beneficial owner standpoint. I think if you want to make an arrangement directly with an institution, for whatever reason you have in mind, and you have fully informed yourself that this revenue stream is commensurate with what you would have typically got had you gone the other way, aka an agency lending discretionary route, then fine, we will support it, I suspect. But the reality is that I don't believe that really exists, and that the only way to really generate and demonstrate price discovery is going down an auction route. So back to your original question, Roy, when done correctly, the actual features of lending those securities exclusively to that borrower look exactly like lending a security at your discretion to any other borrower. In the case I just mentioned, there was indemnification included, which is extraordinary when you think about its implications. I'm not sure whether that happens in today's market, but the sheer operational support is the one that attracts the underlying beneficial owner to using the agency lending route, in my opinion.
Yeah, and if we look back at the history of it, so I started doing exclusives when I was a borrower in the 90s. And there was no question that, as Jeroen said earlier on, it was really fueled by the growth in demand from the hedge funds. And one of the differentiators for a prime broker was, look, I've got access to this much exclusive supply. And so that was, for hot stocks, that was the first call. And I guess the nature of a lot of the hedge fund strategies there was very much reliant on warm or special stocks or sort of trading in names that would become crowded. So there was real value there. One of the things about that time, though, was that as a borrower, often you were kind of trying to go find beneficial owners directly and pick off agent-lender relationships. And I'm kind of hearing from Jeroen, you're saying that you'd prefer to be dealing with an agent directly anyway. And John, you're saying that practically there's just so much work involved that I don't see how you can effectively, or in a risk-controlled and operationally sound basis, really operate in any way other than that. Is that so? John, go ahead.
If I could just jump in there. You're absolutely right, Roy. That was happening. It did ruffle agency lending feathers at the time, because if a borrower has gone directly to an underlying buy-side client, then my approach to that was knock yourself out. Go ahead. You've made a decision. You've had a discussion. You don't need our service. You're actually breaking it. You're coming out of an agency lending route, and you're doing something outside of it. The reality soon dawned on them that no, actually, they wanted all the features, but without the actual discretion, which really meant that what was happening is a product was being developed without the real development of that product going into any effort. So it was kind of bolted together in a crude way, and it wasn't very satisfactory. So I think that today's exclusives, if they are as we are describing, are probably far better serviced. Today's auction process, we know, is very fine-tuned. But I do agree with you that it was happening, but it didn't, in my opinion, it didn't last very long in the way that we initially described it.
So I'd agree with that. I think I have a lot of sympathy for a beneficial owner who's not ever been lending before to want to get the sort of certainty of the fees from the borrower. And so I can see that, because a beneficial owner talking to an agent will get feedback that says, well, we expect to do this. We project the revenue will be at that, and we think it'll probably generate something around like this, or in the last year, this is what it would have generated, but of course, there's no guarantees going forward. And instead, you've got a borrower coming in there saying, boom, I'm going to pay you this much. That's a really compelling argument, isn't it?
Depends who you're asking.
Well, why don't we start with you?
Well, I would say to the underlying, I'd say to the beneficiary, how do you know that revenue stream represents value? Because what research have you done to determine that during the course of, let's say, a 12-month period, the assets in your portfolio may go particularly special? They may not. But what research have you undertaken to determine that, given that you have decided this on your own? What you've done is be seduced by the borrower, who's not doing this for a charity, who's obviously discounted in his own mind, or their mind rather, some value that they think they can extract over the course of the year based on historical activity, which is perfectly understandable. They have to build in a certain amount of protection. But I think the lack of price discovery there is a question mark for the underlying client. Now, I do accept that if a beneficial owner is somewhat concerned by entering a lending program, that maybe some form of exclusive arrangement is the way to start, because it gives them some comfort. But I'd much rather see that working with and from the advice of the beneficial, the agent lender rather, than doing it themselves.
So, Jeroen, all prime brokers are vampires sucking squids that are there to undermine the value of beneficial owner portfolios through exclusives. Discuss.
True. No. No, it's the thing is that in the time when this went on, I was actually on the other side. So I was working at a lender, and we did indeed have prime brokers come in, talk to our clients, and all of a sudden we saw particular securities that were hot at one particular time that we wanted to start lending. They were all of a sudden gone out of the portfolio, and then at a certain time they were back again. What happened? And you start talking to the PM. Said, well, yeah, I traded this on swap, or I traded this on with this particular prime broker. And I think that prime brokers soon discovered that, yeah, the quick gain would have been to go into the prime broker to the portfolio manager and transact a particular set of baskets of securities, or one particular transaction of exclusive for a certain term. But they also knew that as soon as the agent lender found out, they would go on the penalty bench, and they would be cut off from inventory that they would have access to. So I think that this particular play was there, but yeah, I think that prime brokers also understood that they did need the relationship of the agent lender for reasons I said before. The operational hassle that these things take into consideration, but also the fact that the agent lender has more than that one particular client that you did the transaction with, and if you can't trade with all the inventory of the agent lender because the agent lender put you in the sin bin, then that the trade itself was not so good in the first place.
Right. So I think we're all agreed that, although these sorts of transactions can be agreed bilaterally between beneficial owners and prime brokers, there's real value in an agent being part of the process, partly to benchmark pricing through the auctions, add their own expertise of their experiences with the borrowers. And from the borrower's point of view, they would rather have the ability, if they're going to be getting the ability to borrow the stock anyway, they want it to be operationally as efficient as possible. So that's more likely to come through the agent. So if we agree that's in sort of everyone, and most importantly, the beneficial owner's best interest, let's talk about what the benefits are then, I guess, for those beneficial owners. John, so why is there value? You briefly mentioned beneficial owners that are starting off, but tell us what the potential value is and what the issues to be questioning might be.
On the value side of the equation, one of the pros is, as you've mentioned, there is an assurity of a revenue stream. Be that good, bad, or indifferent, you have comfort that you will get paid X amount over the 12-month period. Now, that might be attractive at some point during the life of your relationship if you've come out of a discretionary program and you decide to do this. Or it could be that the portfolio has elements to it that the agent lender could go to a beneficiary and say, look, for your particular asset class in X, Y, and Z, we feel that we could extract more value by packaging that up as an exclusive arrangement to this borrower. And that might extract more value for the borrower and therefore pass that on directly than leaving it at the discretion of me, because I can't tell you that it will all be utilized in the same way. And I think there's value to that as well. I think any savvy agent, any beneficial owner that really gets this business would say, look, I understand I have a diverse and wide portfolio. I know that you've told me that the estimate revenue for the following year will be so much. What else can you do with it, though, if I give you exclusive access? If you can arrange exclusivity yourselves, what else can you extract for me? And I think that approach, I think is probably happening today, or it ought to be, and B, it may actually, for certain asset classes, extract better value. And the reason for that is, if you go back to what we first discussed about why would a beneficial owner do this, it's only going to be attractive, as Jeroen has said, to a borrower that can really utilize that. And if the portfolio is fairly GC or generic, as we like to use that term, they're not going to bid for it exclusively. They want it. Therefore, it should just be left at the discretion of an agency lending program. In other words, it's almost contradictory in terms. If it's so valuable, it will get lent anyway. You'll have high utilization, but you also don't have the concentration risk of an exclusive borrower. The agent lender will distribute that through his distribution network.
Of course, the challenge to that would be, of course, I'm going to get my specials out, but it's the GC part of my portfolio which will be going to other people, and I won't get the benefit from that. And so by doing the exclusive, I'm also making certain that my GC will get borrowed rather than someone else's, because we know my specials will.
Well, therein lies the whole issue around the price of the exclusive. Because Jeroen, being the stellar chap he is going to price it with a fair amount of protection from his. He's making a real commitment here, which is going to need approvals, all kinds of levels. And there's no way that they're going to price that acutely at the sort of the high end of a curve, just because there are the anticipation of certain specials exist. In other words, it's still discounted heavily. Unless you
So, Jeroen, discounted heavily?
Well, depends. Yes and no. If it is something I really, really need, I'm really able to pay up for it and maybe even pay market conditions. So I'm taking a punt that everything in that portfolio stays the value that I think it will be, and I will be able to use it throughout the entire tenure of the exclusive and hopefully make a profit out of it. But my main reason was to get supply in order to facilitate my hedge fund client, and my revenue will come from the additional execution, additional transaction I'm doing with my hedge funds. That's one side of the transaction. The other side of the transaction is exactly as John says. If I am not too sure that I need it, but I think there's value in it, of course I'm going to be bidding on it. But I'm going to be bidding on it in such a way then I'm making money out of it as well. So there still needs to be a spread for me in order to take on the exclusive, and on top of it, take on the risk that I'm taking for the tenure of the transaction. So if all of a sudden all the exclusives fall out of the portfolio, then my spread is gone, but also I will be making a loss because I'll be paying money away for something I do not need and can't use. So yes, on that point, John is right that there will always be a certain factor, a certain spread in the pricing when going back to offering offering the bids to the agent lender, on the fact that I need to make money as well.
Yeah, it's probably not like, it's a little bit more sophisticated than it was in the early years of this century when I was at a firm and we took down big baskets of Korean exclusives at a massive premium because the market was opening up. All of our hedge fund customers wanted to be trading in Korea, so we locked up portfolio after portfolio. And then we realized that the underlying portfolios weren't nearly diverse enough to satisfy the hedge fund trading strategies that they were trying to implement. And effectively, we were paying money for nothing. So I suspect there isn't quite that freewheeling bidding frenzy that we actually see today, or saw in the past. John, one of the other things that comes up sometimes is the collateral side of things, and beneficial owners may also have an ulterior motive in terms of getting cash collateral. Can you maybe talk us through that?
Yeah, very much so. So there are a number of beneficial owners, and they typically are US based, where the whole point of securities lending is to raise cash, which they then reinvest in their own money market funds. Securities lending therefore becomes a means to generate revenue, generate the cash, which they have other reasons. Well, they have reasons to do that, and therefore it becomes incidental. If it's incidental in terms of lending those securities, but you're not clear how much cash you're ever going to have at any given time, perhaps for those type of that particular sector of the market, an exclusive does make some sense. However, they would have to insist in that approach that the borrower maintains a minimum balance, so there can be A, they have a revenue stream, and B, they have a cash stream which they can rely on. And I'm going to suspect, Jeroen, that if you've ever experienced that, it was indeed the case.
Well, I've come through a vast variety of auctions where a minimum drawdown, as they would call it, was required. But since Basel III came into play, a minimum drawdown, so a fast set of cash out the door for a set amount of time, and quite often it was a year, would be a very punitive transaction from a liquidity coverage ratio, because you get HQLA, high quality liquid assets out the door, i.e. cash, and quite often you're borrowing equities in return, which are non-liquid according to LCR regulation, and thereby you're already minus 30, 35 basis points before you start to trade.
Which is then built into your price for the auction.
Yes, and quite often it would be negligible. You can't do it anymore.
No, exactly.
Yeah.
Right. The other reason, Roy, that collateral is important in this arrangement is that it could be that the beneficial loan has specifically, you could argue, let's call it liberal guidelines. And let's say in cash collateral, they're allowed to do certain things with it, or they absolutely approve certain instruments which are very liquid and available to reinvest in. That might actually, and therefore a lot of their revenue attribution comes from the reinvestment side, which is still possible. It's not for everybody, though, and certainly not for the faint-hearted. It could be that kind of exclusive arrangement to raise cash just for those purposes benefits them for the reasons I described earlier. So you could end up with something along the lines, but not necessarily a mutual fund doing that.
Right. So I guess if we look at it, borrowers still value I guess, assets that have an intrinsically high value, and exclusivity has definite benefits for them in their business program. For agent lenders, I think, John, you were talking about it being kind of a portfolio solutions for their clients, for the right client, the right portfolio. And for beneficial owners, it can provide certainty of income rather than peaks and troughs of real life. And there may also be a sort of a sideline of collateral reinvestment opportunity for the right customer in the right situation. So I think there's a little bit of it in it for everyone. But I think what I've heard from both of you is that it's not for everyone. It's not for every situation. And there are limits as to how much value it can bring, but definitely for the right segment, a lot of value. So Jeroen, would you have anything to add to that summary?
Well, yes, Roy, and that is more looking forward and more looking at the current environment, and that is that a lot of the PBs, a lot of the investment banks will have the requirement to internalize their assets first. So the fact that they've gone out and bought those exclusives back in the day worked fine at one particular time. Now, with the capital requirements that are in place, it's much more important for them to sweat their assets and look at the assets that they have on the balance sheet, and therefore might not be able to go out and start bidding on generic inventory that comes to auction. Much more what they will do is they will go to certain agent lenders and or beneficial owners that lend themselves directly and say, okay, fine, I have a particular need in these particular securities. Can we set up an exclusive around it? And then the process goes from there. So I think that the time that people just send things to the market and hopefully got a good bid on it via an auction, I think that we moved away a bit from that process, and it's much more customized now.
Right. Thanks for that, John. Anything to add to amend or tweak on that summary?
Yeah, a couple of things. Between 2012 and 15, I performed a annual auction for a very large asset manager client, and every year the assets were pretty stable. Every year the bids coming back were lower than the previous year. The portfolio was roughly the same. But what I did notice more than anything else were the caveats that the borrowing community placed on the portfolio were getting tighter and tighter, and to the point where I think in the last one we did, the most valuable of 6 portfolios, it was impossible for the client to make a decision to be that restrictive that they ended up not doing it at all. Unfortunately, they ended up not giving it to us as a discretionary lender either. But so I think, as Jeroen says, maybe the heyday of this type of activities in the past. One thing I will add, though, in terms of a client looking at an agent lending program that is huge, they're huge by reputation, they're huge by what they can read in the press. They have hundreds of clients in their program, and therefore the subject to the sort of fair allocation algorithm is something that all clients in that program are going to be subject to. And it could be that they determine that coming outside of that may be to their advantage. But I think that would only apply to a client with assets that are known to be valuable at all times of the year. And I'm particularly thinking about HQLA, for example. That, the demand for that is going to be there, whatever the fee may be. And I think that perhaps that's quite a easy, digestible scenario for a borrower to look at.
Right, and that's a good point. When we talk about collateral transformation trades, the reality is that collateral transformation isn't just for Christmas; it is really for life. Those are sort of ongoing trades. The trend will continue. The demand for that HQLA collateral will continue until we have some kind of an unforeseen fundamental change in the way that the market thinks. So that's an interesting one. We've seen rates for that spike over the turmoil that we saw last quarter. It's not really got back to the levels it was at a few years ago, but it's I suppose a reasonable return and certainly presents greater continuity for both parties, right? So it's better for a beneficial owner who will know that they have that kind of revenue stream. It's also good from a borrower point of view because they know that there'll be that constant demand. So presumably, Jeroen, less of a discount if you can lock up something like that.
True. Yes. Correct.
Okay. So, but where do you guys think the market is? So we've talked, both of you have talked a little bit about its future. So if you had to summarize, maybe John, the auction model, exclusives, where do you see the future for this?
I think I see it as a hybrid. Why would you restrict yourself if the possibility that there is a borrower out there that is looking for a pocket of certain assets that is willing to pay up for those assets? I think that should always be explored. In other words, an agent lender should have a very wide and diverse group of borrowers, and you should be seeking. And the reason why you should always add to new borrowers and not just go to the usual suspects is that if you can get it through credit, you may have a domestic Korean borrower that has insatiable demand for, as you say, Roy, Korea, despite its, the pricklier parts of actually lending in Korea, that might actually serve your underlying client well. So I think auctions, because the price discovery is greater, very much have a place within a agent lender's arsenal and should be used where they can. But I don't think the demand for them is what it used to be. And for all the reasons that Jeroen pointed out, they're more expensive. Let's face it, ESEC lending makes a business out of this, and they do extremely well from what I understand. So their model isn't particularly changing, and therefore they've managed to extract value from this.
Yeah, one of the points that you brought out that I hear from time to time from beneficial owners is exactly what you talked about in terms of credit appetite. The truth is some beneficial owners will look at it and say, oh, there's 30, 40, 50 borrowers in an agent program, and I might have exposure to them. And I understand about diversification, and I understand that the biggest borrowers are likely to end up with the biggest allocations. But every beneficial owner that I speak to understands that they can exclude borrowers from the program or cap their exposures. But quite frankly, one of the things that some people like is that they can get the auction results in, see what the range of bids are, and may opt to take not necessarily the highest bid because they specifically want to have their securities lending exposure to counterparty A or counterparty B. Have you come across that?
In my past, we've never executed an exclusive or an auction process without indemnification. In theory, you could argue that it should be without it, because especially if the underlying beneficial owner is making the decision themselves. But by having the indemnification, a wide group of borrowers, you actually achieve both. So the outcome is actually improved. So absolutely, I've come across that, but I can't see a beneficial owner being attracted to an exclusive arrangement, whatever route you're going down, unless the agent lender is providing that indemnification.
Yeah, I think we should probably have an episode on indemnification because there's a wide range of views from beneficial owners. So maybe we'll park that for another episode. And as I said recently, if there are subjects that our listeners want us to talk about, like indemnifications or anything else, just drop us a line and we'll put together a program on that. Jeroen, what do you think about sort of the future of exclusives across the market?
Well, one of the things I said earlier as well is that it becomes much more customized. A borrower who would look at the lending community and think, okay, fine, I need X, Y, Z. Who can provide it to me? Who can provide it to me on an exclusive basis? And let's have a chat and let's build a relationship around that. Of course, those are big auctions. The borrowers always want to see them, always want to have a feel what's going on in the market, who's sending things to the market, what's in those portfolios. And when I would receive those auctions, when I was working for a borrower, I would always price them. I would always see what the value is. Can we use it? Yes or no? And sometimes you think, well, you know what? Let's put in a cheeky bid because it's a free call option. And if you win the portfolio, you would get inventory, and it could be potentially on a reasonably inexpensive way to get inventory, and you never know what could happen. So it's more like a punt you're taking on a position. That being said, I think that we're talking about the HQLA thing. I think exclusives in a form HQLA doesn't really work in such a way because it's quite technical. But if you go 1 year exclusive on a HQLA, it actually is 3 month term plus 1 month, or so 2 times 1 month term in the money market area. So that's not working. However, extendables, you can maybe consider those as exclusives as well. And that is definitely working for the borrower market.
So maybe before you move on to your next point, maybe just explain what an extendable is.
So an extendable is a transaction in which the lender will lend quite often high quality liquid assets on a term basis, and that term can then be a rolling term. So it could be an evergreen transactions where it's 3 months term. So if you call the transaction, you can only get the securities back in 3 months' time. And then there are different hybrid models on how that's working, and all those combined you call extendables. But I think that's potentially also a different topic for an exclusive for another podcast.
Right. So thanks for that, guys. We've covered a wide range of activities. What are they? What's the history? What are the benefits? We've talked about a number of the drawbacks and problems that can be faced. We talked about the futures. So really, any closing thoughts on exclusives? And maybe, John, if I could ask you to start with your thoughts.
One of the interesting things that I was thinking about earlier this morning was the fact that we talked about the Q, or the fair allocation algorithm, and exclusives come out of that completely. If you're a beneficial owner and you suspect that your agent lender has a huge amount of exclusive arrangements on their books, for want of a better word, that means that borrowers are always going to take that down first, because by definition they have to use them, and they're going to use them first and foremost. Could it be that one of the better questions that should be asked in an RFP is very much that? What is the size of your portfolio or your assets that are available for exclusive arrangements, and how do you marry that up against my ability to enter, to be part of a fair allocation algorithm? That's the way I think in terms of, I want to write the RFP from hell eventually. Again, all those questions I never answer, and that's what I just thought of. The last point about exclusives in general is the risk of renegotiation. Maybe Jeroen answers that, but in the language that I've seen in the past that comes back, where it gets very tight in terms of changes to the portfolio, or even down to changes to particular assets, it's very hard to digest that sometimes. And when that risk of renegotiation is triggered, it's usually fairly punitive to the underlying beneficial owner. It's almost as if all bets are off and we've got to start again from a much lower base. I think that risk needs to be always considered when entering these arrangements.
Great. So Roy, to comment on that. So general remarks, I think that the area of the big exclusives and everybody buying them and making money out of it, I think those days are over. I think capital requirements really killed that off. However, there will always be a need for inventory, and if you can lock up inventory against a decent price, then that's a trade-off. So that would work. But an exclusive does bring risks with it. And John was saying, well, the risk from the lender is X, Y, Z. Yeah, you're right. So he has exposure and potentially less fees, but the risk for the borrower is also quite quite there, because he is committed to paying a certain amount for a certain time, and he is not sure whether or not he can recoup those costs. And in order for him to safeguard himself as much as possible against those risks, he comes up with caveats around the exclusives. And you're right, sometimes those are trigger points whereby the economics of the exclusive has changed so dramatically that because of different reasons, but that because of that, the borrower is starting to lose money, and that's why he's going to go, hang on, we hit one of the trigger points in the negotiations, we hit one of the trigger points in the original agreement. I want to renegotiate the fee, and quite often that is punitive for the lender, because the borrower is not going to go, oh, I'm going to pay you more now. Is that all right with you? It will always be less.
Which is exactly why, Jeroen, that these arrangements are not for everybody. If you have if your portfolio has a high turnover, it will make a mockery of trying to do an exclusive arrangements. So I think I never really touched on this, but the stability of that portfolio is only going to be, the degree of stability is very, very important in coming to this decision in the first place. I mean, I've had clients in the past come to me and say, what do you think about this? And we've looked at their turnover and said, you would get triggered so quickly based on your past performance that it's not worth entering into.
Yeah, I agree, and especially for a borrower, it is extremely important that you trigger the portfolio versus, or you track the portfolio versus what you originally bid on versus what it is now, and potentially what it is in a month or 3 months or 6 months time. And luckily, there are very good systems to do that in the market. So, but it is very important.
Right. Tracking portfolio composition and changes is really essential, whether you're a beneficial owner, agent, or borrower in this, because it has cost implications for everyone. Look, guys, thanks very much. I think that was a really wide-ranging and in-depth discussion of the pros and cons and characteristics of it. So thanks very much. I'll be back in a few moments just to summarize my takeaways from this session. But thanks, guys. Appreciate your time and thoughts.
You're welcome.
Thanks, Roy.
So that's a wrap for this episode. I apologize for the sound quality at times. It looks like the internet gods were not always smiling on us today. So we'll check the plumbing, and hopefully we'll get back to normal quality again next week. But look, I hope that the conversation itself was enough to keep you engaged and interested today. I think a few things came out from my point of view. First, and perhaps most importantly, exclusives are still a feature of the market and will continue to be for as long as we can tell. While they may not be as large a part of the market as they were 15 years ago, look, the reality is there will always be a demand for portfolios that have attractive aspects to it. Scarcity value will always have some meaning to borrowers in the market today, tomorrow, and forever. From an investor's point of view, it has a number of different benefits. If you're new to the market, the certainty of an exclusive revenue stream is a really key important issue for a number of people. The reality is, if you're going into it for the first time, you want to have some idea of how much money you'll make, and so exclusives might be one way that you actually capture that clear revenue figure. Of course, the trade-off for certainty is that you'll never make as much money as you would from discretionary lending in a bull market. On the other hand, you won't suffer the profit falls that you might experience if it's a quiet market or a very flatlining market, or in fact a flat, slowly declining market with not much activity. That's the worst scenario you could possibly imagine from a lending point of view. So for new lenders, and in fact existing lenders that just want that certainty and don't mind missing the tops and are quite happy to miss the bottoms, it's a great solution for them if the portfolio is attractive. Now, from a different point of view, some investors like exclusives because of the cash reinvestment angle. And that cash reinvestment is really critical in good interest rate environments, or at least better interest rate environments that we might be in right at this moment. And what exclusives do is it means that a lender will have certainty of a pool of money that they can play the curve with. So depending on what the investor's objective is, exclusives can also play an important role in that part of it. So we expect, and we already see this today, that agent lenders will continue to bring exclusives to the table. The reality is that they are part of that kind of portfolio approach of lending where you have discretionary activity. Sometimes the large clients want to do some of their own high margin lending themselves. Other clients want to avoid the low margin general collateral or GC type of activity. So all of this is very specific and unique client by client, and we think exclusives have an important role to play there. Look, as with everything in our lives today, regulation plays a role. It certainly had an impact on the attractiveness of some exclusives, and it will be there forever and continue to have an impact. Unless we see some kind of a departure from the current thinking, I think that longer term exclusives will continue to be negatively impacted by regulations, but scarcity value, I think, often wins out. So that's a wrap. I'd like to thank John and Jeroen for sharing their thoughts with us today. We talked about a couple of different things today. If you want to hear more episodes on exclusives or collateral or any of the topics that we talk about in this or other podcasts, let us know. We're happy to put shows together. We want to put together stories that are of interest to you. You can find our contact details in the show notes. We always leave fairly detailed show notes. We put out a lot of content in securities lending. It's free. You can find it on our website, www.pierpoint.info. We're very active on LinkedIn and Facebook, where we are Pierpoint Financial Consulting. We're on Twitter as Pierpoint FC. And again, all of those details will be in the show notes. So that's it. That's a wrap for today. This has been Pierpoint Perspectives, the art of securities finance. I'm Roy Zimmerhansl, and I look forward to catching you next time.